Greetings. We're going to go through homework number 5. We may wind up doing it in 2 different or 3 different sessions, so I keep the sessions short. But here, let's just jump right in, and we'll go through and try to understand the reasons for the answers to each question. Number 1, which is the following statements being true? And we go through number A, individual engaged in the conduct of business must elect not to be taxed as a partnership. Well, an individual is a sole prop. There's nothing they can do about it. You cannot elect to be a partnership, and you're not, by default, you're not a partnership. You're just a sole proprietorship, so that's false. Formation of a partnership requires legal documentation. I think we covered that in class pretty well, at least I tried to. That is not true. If partnership is just 2 people getting together, even without doing any legal documentation, you are a partnership. Not recommend it to do it without a legal documentation. I certainly recommend to have some kind of formal documents explaining how the partnership is going to work, but you don't have to have it. C, a partnership exists as long as there's 2 individuals or entities engaged in the active conduct of a trade or business or a financial operation, and the business is not a trust or a corporation, and that is a true statement. And that's what makes that. And so D is not part of the answer because there is a true answer. If you don't quite follow why C is a true answer, check the textbook out for the definition of a partnership, because it's probably going to say exactly what you see in C. Which of the following is false? We're on number 2. Here, these are questions about a large partnership. It's in the text. That's why I put it in here. This is not going to be part of a quiz. I'm not going to ask about large partnerships. But if all you got from the textbook trying to read through that material was that a large partnership by definition is one with greater than 100 partners, then you would know that B is false, and that's your correct answer. B is the false one. Okay. This question asks, how much of the loss can Carol report on her tax return for the current year? This is going to be a test on partnership basis. So we're going to be looking into Carol's basis of her partnership here for purposes of determining whether she can take the loss. And of course, the 2 parts of the test that are of importance to us is first the tax basis. If she passes the test that she has enough tax basis for the loss being allocated to her, then you go to the next test, which is the at-risk basis. If she passes that test, then if she's materially participating, which it says she is, then she'll be able to take the loss. So let's see what her basis is. Let's go through the mathematics. She purchases her interest in the partnership for $30,000 cash. So here we're trying to figure out what her basis is. Let's do the mathematics and see what happens. First, we know what you part into the partnership or what your purchase price is begins your basis. There, we're told that they have recourse liabilities, and she's going to share in the recourse liabilities. The problem explains to us to the way she shares partnership losses, and since the 50% interest is not broken down in the problem between profit, loss, or equity, we can only assume, and we have to assume, that her share of the recourse liabilities will be half, or $20,000. That brings her total basis up to 50. This recourse liability is recourse and therefore is at risk, so it does not become an adjustment for at-risk basis. So at this point in time, our 50 passes the test of being both tax basis and the at-risk basis. How much are her losses? Well, the loss is $120,000, and that equates to half of that goes to her. $60,000 will come off. But before we do that, we have to increase her basis, because we're told that at the end of the year there's an increase in liabilities, $20,000, and that increase in liabilities is going to be added to her tax basis. It's going to be added to her tax basis, and so assuming that the only liabilities she has, and that's the only liabilities we know about, are recourse, so we'll have that add to the at-risk basis as well. She gets if the total liabilities increase was $20,000, $10,000 of it is hers, and now she has a basis of 60, and therefore the loss, which is 60, passes the test for both tax basis and at-risk basis. Of course, her basis will be 0 after absorbing the loss in the current year, but the answer is A. Let's try another one, see if we can get how many we can get through. Identify which of the following statements are true. If money distributions exceed the partnership's basis in the partnership interest, the partner would have to recognize gain. When the distribution from the partnership, such gain is an ordinary gain. Well, everything's good up until the fact that it said ordinary gain. There is a gain on this kind of distribution where it goes beyond the basis, but it would be not an ordinary, but a capital gain. B, distribution of partnership income in the form of cash is generally tax-free, and that one is the concept of generally tax-free. We did discuss that, as long as there's basis, of course, but generally there is basis. We'll discuss why in a second. So B looks to be true. Let's look at C. When partners receive cash distribution, they pay taxes, and that one we better have gotten, because I killed that as much as I could. Distributions are not taxable when they're received. It's not part of how you determine tax. Yes, if distributions exceed basis, you have a capital gain, but the distributions themselves, by and large, are not taxable. Let's look at B again. The reason B generally works is if there is partnership income, and you're trying to figure out basis, partnership income increases basis, and if the distribution is nothing more than the amount of the income, it decreases basis. So you might start at 0, but if all you're doing is making some income that increases basis here, and then at this point distributing the same amount of money, you wind up with 0, but at least you had the ability to distribute the cash tax-free. The income tax is paid on this part, and the distribution is just distributing the income you've already paid tax on. So it's no matter when you distribute it. So it would be no matter when. Could be the same year that the income is made, could be any future year. So no matter when. Okay. All right, let's try one more, and then we'll maybe take a break. Number 5, Ken pays $10,000 for a 20% interest in a general partnership, which has recourse liabilities. This question's asking for basis, so we're back to that. What's the basis? There we go again. So let's see what he's got. He has a 20% interest. He paid $10,000. That's part of his basis. Recourse liabilities, he gets 20% of the recourse liabilities. Last time I checked, 20% of $20,000 is, it better be 4. I hope it is. I'm not doing the calculator check. But his share of, and it's recourse, so he includes it in both his tax basis and his at-risk basis. The partners share the economic risk of loss in the same way, so that tells us we can add the percentage. That's 20% is what we're adding here. The next sentence in the problem told us we could do what I just did. His basis in the partnership should be $14,000. That should be the answer. And we're done with that problem. All right, so we'll try one more, although I'm running out of space. Song contributes a machine having an adjusted basis of $20,000, fair market value $25,000. He gets a 10% partnership interest. What do we want to know? We want to know if Young, or Song, I guess it is, should recognize a gain through the process of contributing this machine. After all, its basis in his hands was 20, but the fair market value was 25. The value of the 10% partnership interest he got is probably worth $25,000, the fair market value. Does he have a gain? Well, we know under Section 721 that most of these transactions do not have a gain. Not only that, but Song had taken $10,000 depreciation, so is there recapture when he does this? And the answer is Section 721 says no gain, no way, no how, no, it's not. It's a tax-deferred event. A is the correct answer. And if you're not sure why that is, go back to the text, look at section 721 again, review any notes that you took on it, because that is it in a nutshell. All right, let's pause here. We'll start with the question 7 on the next go around.